How do legendary investors approach asset allocation? When it comes to managing investments, legendary investors have unique strategies that set them apart. One key aspect is their approach to asset allocation. They understand that a well-balanced portfolio can weather different economic climates. Let's break down how they do this. First, many top investors focus on diversification. This means spreading investments across various asset classes like stocks, bonds, commodities, and currencies. For instance, Ray Dalio created the all-weather portfolio. This design aims to perform well in any economic situation by balancing different asset classes. He uses a method called risk parity, which focuses on balancing risk rather than just the amount of money invested in each asset. Next, managing risk is a priority. Investors like George Soros are known for their macro trading strategies. They use leverage but always have clear exit plans. This flexibility allows them to adjust quickly to market changes, helping to control potential losses while seeking new opportunities. The style of investing also plays a role in asset allocation. Value investors such as John Neff and Walter Schloss look for stocks priced below their true value. They often prefer companies that pay dividends or are considered bargains. For example, Schloss sometimes held as many as 70 stocks to reduce risks tied to any single company. Growth investors, like Peter Lynch, seek companies with strong earnings growth but also pay attention to price to avoid overpaying. Another strategy involves making tactical adjustments based on market conditions. Legendary investors may shift their allocations in response to market valuations. During the dot-com bubble, Jack Bogle reduced his exposure to overpriced U.S. stocks to avoid significant losses. Tactical asset allocation means changing portfolio weights to take advantage of undervalued assets or cut back on overvalued ones. However, this requires careful judgment to avoid mistakes. Some investors also focus on factor diversification. This means diversifying based on investment factors such as size, value, and momentum, rather than just asset classes. Larry Swedroe emphasizes taking risks mainly in equities while diversifying among small cap, value, and momentum factors to improve returns. Consistency and discipline are common traits among legendary investors. They establish a clear target asset allocation and stick to it, even during market fluctuations. This discipline helps them avoid emotional decisions and keeps their long-term goals in sight. For practical financial planning, it is essential to create a diversified portfolio across multiple asset classes. Define your investment style, whether it is value, growth, or a mix, and select assets that align with that style. Consider making tactical shifts when market valuations are extreme, but avoid frequent changes that could lead to higher costs or mistakes. Use risk management tools and stay flexible to adapt to changing market conditions. Maintaining discipline by sticking to a target asset allocation that matches your risk tolerance and financial goals is vital. By incorporating these strategies, investors can build resilient portfolios that align with their individual philosophies and adapt to various economic environments.